Hello and welcome to a new episode of the Ratings Rundown with me, Angela Ashton, Director of Evergreen Ratings. Today I'm very happy to have Brett Craig, who is a Director of Private Credit at Aura Group, with us. We have recently rated the Aura Private Credit Income Fund. We've done that for a number of years in a row and it's received our highest rating this year of highly commended. The fund is an open-ended unit trust which provides investors with exposure to Australian private credit and has a monthly income stream that has averaged 9.5% per annum since inception. So today we'll talk to Brett a little bit about the fund itself, as well as his impressions of the private credit market overall. It's obviously very topical and something that we're lucky to have Brett here to talk to us about. So just a little bit of housekeeping, ratings are only one factor you should consider when in investing in a financial product, and any ratings that we do issue are subject to change. Our rating scale and research methodology is available on our website. The link will appear in the description at some point. And with that out of the way, I will start the discussion with Brett. Thank you for being here today, Brett.
Great to be with you, Angela. Thank you for having us, and thank you for the rating and the time spent by the Evergreen team throughout that process.
Well, it's been a pleasure. How would you briefly describe the fund, Brett?
So we are focused on providing debt financing to Australian business lenders. So the underlying exposures within our fund are Australian business loans. They are all secured with some level of security, whether that be personal guarantees from directors, property, receivables, physical assets, etc. So we are lending into the real economy in the Australian market only. We do it through warehousing structures, so the lenders that we finance have skin in the game below our investor capital as an additional layer of protection. We're very much focused on highly granular portfolios, so a lot of smaller debt exposures to businesses in the real economy. We do not do property development finance, so we don't lend to put up a high-rise or duplexes, etc. We do complete loans to the construction sector, but not for the development purposes. So if you think about what we're doing, we're really lending into that real economy, the SME and mid-market corporate sector. We don't do the big end of town. Obviously, the banks are very much focused on that big end of town, but they've really let slide on that smaller end of town, which is where our lenders are stepping into the breach.
Great, thank you for that. Let's start with, I guess, a bigger, broader question. What's your impression of the current state of private credit investing, both here in Australia and globally?
It's very topical right now, and we've seen today we're doing the recording. It's the 25th of February. In the last 2 weeks, we've seen some issues in the US. A large group there have locked a fund and sold 30% of the assets within that fund at a small discount, mind you, but there's a lot of questions around what remains in the 70% of that fund. Now, if you're looking at global private credit, there's been huge amounts of capital pushed towards data centers, SaaS businesses, etc. And I think everyone is starting to question the economics around the AI revolution. There is no doubt some benefit there. It's a huge technological advancement, but what are the back-end economics going to look like? So that's that offshore experience that we're seeing. A lot of those offshore corporates, those loans are based on cash flow financing. So the hard asset backing behind them can be lean and sort of predicated on strong future growth and cash flows in those businesses. So I think people are questioning some of those credits. Domestically, a lot of the financing is being done to property development. So we're seeing large funds funneling capital towards property development. We obviously have some structural issues in Australia where we do have an undersupply of housing, etc. So there is a need for it. But obviously the construction sector has had its ups and downs recently with cost pressures with, the inflation rate that we currently have. So I would say the Australian private credit market differs quite a bit from the offshore in that the vast majority of the market is skewed towards property development at the moment, or very large corporates or LBOs. Where we play is in that SME to mid-market corporate. Just for some context, we have over 13,000 loans within our portfolio.
And how big is the fund at the moment?
So we're just over 530 in the wholesale vehicle there.
Yeah, so the loans are small.
Yeah, we're looking at, weighted average loan sizes around $130,000, so relatively small. We do larger loans against property, so we've got the maximum exposure we have is around $17 million within the fund, but we've got a concentration limit of up to 5% of the fund within that vehicle. So we look at having a very granular portfolio there. My background is in securitization. One of the core principles there is diversification of exposures, spreading that risk across different industries, different maturity profiles, different asset types. So slightly different to your chunkier style private credit operation. But I think the other sort of structural tailwind for Australian private credit is the banks have stepped back from that mid-market corporate and SME lending, really focusing and skewing their balance sheets towards home loans, home lending, or the big end of town. So your very large rated corporates. And that's where they get the best regulatory capital treatment. The banks are very good at lending and they're just trying to optimize their returns for investors. So, I think what we're trying to do is use a lot of that bank methodology in our lending. We think the banks lend really well in Australia. They do a great job. They're just not focused on a sector. You've got the non-bank sector stepping in and trying to fill that need for financing from Aussie businesses. And it's providing a good tailwind and in our view, great risk-adjusted returns for investors. Yeah.
So let's just step back and clarify something for the listener. With respect to the reason why this has opened up in banks' balance sheets and the way that they invest, or lend, it's really about the fact that they changed the regulatory requirements around capital, which was really a result of the global financial crisis. So the way that capital on bank balance sheets was treated has been changed as a result of the GFC, and that's opened up a market in Australia that we now call private credit, because the banks don't really lend to that, because it's not great for their balance sheets.
They have to hold more regulatory capital against those loans, so their return on regulatory capital drops because they're holding more capital against those exposures. They're looking to optimise a number of metrics, return on equity and return on reg cap, and as a result, they're really, they get very good treatment for home loans, and we've seen that market. I mean, it's a huge market in Australia, or your BHPs, Rios, etc. And even those are struggling on ESG terms, but that's another story. But they're focused on some of those larger corporates. Yes.
What's your thoughts around private credit here in Australia?
I think there's some really good operators in the Aussie market. And look, we've been around for coming up on 10 years now. Our fund's been in market. So we were around pre-COVID. There were a number of operators around in market that are still going today and doing a very good job. I think as we rolled through COVID, we started to see the breakdown of the traditional 60/40/70/30 portfolio to bonds and equities. And we did see that portfolios that had some alternatives in there, some private assets in there, did have lower levels of volatility. And what that meant was a lot of allocators and advisors started to explore private markets. And we saw huge growth in Europe and the US in private markets, both private equity and private credit. And what we've seen post-GFC in the Aussie market is an absolute explosion of the number of funds. I mean, you would have had hundreds of requests for ratings, no doubt. And, what we're seeing is a lot of mortgage brokers wanting to become private credit managers. And I think what they're very good at is originating exposures, talking to those borrowers and encouraging them and helping them structure financing, but they're not great at taking on the exposure and managing the risk. So we've seen sort of a bit of a bifurcation in market where you've got a lot of people who have rolled out of the banking sector, and I think the Australian banking sector is a great learning ground in the credit space. our financial system's been very robust. We've got very tight regulations. Got a lot of data around lending in the market, which enables you to make your risk decisions. But I think a lot of people saw a potential golden goose out there and tried to pivot their businesses and become private credit managers. So we've seen a lot of private credit managers emerging, and I'd say you've got some that may have some pretty lax due diligence processes and risk standards, and just look at raising capital and deploying that capital. We've seen some recent issues in portfolios, and I mean we've got plenty of negative press around private credit due to some of these failures, and it's warranted.
Yeah.
But you don't want good operators being tarred with that brush. So I think we're going to see a bit of a consolidation in market. I think there'll be subscale players who won't make it, and the economics of their business won't stack up. I think particularly if they don't have the right frameworks around their credit business and their funds management business with respect to governance, compliance, fund structuring, due diligence, etc., they won't attract the capital. And I mean, these are all the things that rating agencies go through when they look at our funds. And I think agencies such as Evergreen have seen where things go wrong, even just in the fund's structural setup, and point out that as a concern. We've seen a case this morning, in fact, a group who have some concerns in their portfolio. They've raised capital through a private credit fund, and there's been some issues, all to be determined, and it's in the press at the moment, but some potential issues around disclosures and assets in trust there. So, I think all of these elements are things that we keep a very close eye on, and I think what we try and do is just run a bank grade process. We take on a lot of advice from consultants such as Evergreen as to the ideal structure and how do you set things up to ensure that there are investor protections in there should investment managers get things wrong or there be problems with that corporate. So we look to adopt those changes. And I think a huge thing that's occurred in the private credit market in Australia in the last 12 months, obviously ASIC have seen some of these issues emerging, and they're trying to protect investors in the market and ensure best practice. So ASIC have completed a review of 28 private credit funds in market. We had one of our funds included in that 28. It's actually our retail vehicle. So we run two vehicles, the Aura Private Credit Income Fund, which is our wholesale vehicle, and the Aura Core Income Fund, which is our retail vehicle. ASIC ran an analysis over our vehicle. We've got some very minor changes that we completed on our target market determination, just to run in line with the recommendations of ASIC. But outside of that, I think we're in a good position off the back of that review.
Great. Well, thank you for that. Let's move on to the fund itself and talk about that for a little bit. How does this fund, well, we've sort of touched on it, but let's go into a bit more detail. How does this fund differ from many of the other products you see in this sector?
Yeah, so I mean, a lot of the funds in the sector will look at direct lending. So they'll go and find the business, find the property developer, find that construction company looking for the financing and lend directly from their fund vehicle to the corporate. Other funds will look at, providing leverage for private equity to make an acquisition. Some will look at distressed debt. Some will look at infrastructure debt. I mean, private credit is a very broad church. It, effectively comes down to providing debt capital to a borrower and then making sure that your returns are commensurate with the risk that you're taking there. Other funds in market will look at securitized assets, which is what we invest into. The residential mortgage-backed security market is huge in Australia, as is the asset-backed market, and there's a number of specialist funds that have looked at public market securities there for years, and now they're looking at sort of a hybrid of public and private securitized products. We see other funds looking at personal lending, so consumer lending, RMBS, and business exposures within their funds. What we've focused on since the inception of our business is providing debt capital into the business sector. We saw a huge funding gap in the business sector in Australia. I'm the product of a small business. I've seen what it's like for a small business family looking to borrow money from the banks, and it's become increasingly difficult. And I think the reality is if you don't have a property and you are not an existing bank customer, it's quite hard to get debt capital from a bank these days. We saw the gap in market. It's a very significant gap. It's over a $300 billion funding gap in market. So that's unmet funding demand in market. So just loans not being written. So that's a huge space to grow into. Yeah. And in our view, when you're lending to a business that is looking, the use of funds is to continue growth and increase their profitability. That is a great use of funds. If you're looking at lending to a consumer to consolidate credit card debt, that's generally a weaker balance sheet. Now, obviously, they're trying to reduce their debt load, but your recourse is quite limited if they default.
Yeah.
So we've always focused on, the RMBS market. I mean, it's huge, it's liquid, spreads are very tight. Yeah. So, I think you get a good return for very low risk in that market. It's a great market. But what we're trying to do is achieve enhanced returns for the same level of risk for our investors. So our objective as a fund is to preserve capital for our investors, but get a yield that exceeds a comparable risk in a public market.
So I think it's cash plus 5?
We target cash plus 5. And look, we've seen some, from a macro perspective, we've seen some concerns around the economy in Australia. So we've taken some risk off the table. So we've been running around the 5% mark, but our view is to reduce the risk in the portfolio. Firstly, our objective is to protect capital. We think investors pay us for that first. That's objective number 1. Then hit our risk-adjusted return.
Yeah, okay. Let's talk about credit risk modelling. How do you look at that in the fund?
So initially, most of my team come out of banks. So we've always modelled the risk internally as a house and done that based on what was bank methodology. We've never disclosed those ratings to our investors because that's kind of marking your own homework in our view. We've always had funds ratings. I mean, Evergreen was our first rating for the fund.
And you were our first rating.
Yeah. It's been a long relationship there.
Yep.
So we've always had sort of external fund ratings, but what we've done in the last year is actually adopt external credit risk ratings on each of the underlying exposures. So, it costs us over $250,000 a year to get that done. It's a group who work for 3 of the big 4 banks and have built their reg cap risk models. And each month they analyse each of our 13,000 loans. For the credit risk, they calculate a probability default and a loss given default outcome based on a 1 million simulation Monte Carlo analysis on the portfolio. So we're looking at multi-cycle stress tests, interest rate stress tests, etc., that are applied to the fund, and we disclose that to our investors each month. So it's a guide on the risk that we're taking for our investors, and it's a model that's been approved by APRA.
Right. Okay.
Yeah.
Let's talk a little bit more about new investment avenues that you're thinking about. Is there anything else that you're thinking about in the fund that you'd like to grow into?
So we want to stick to our knitting. I think as soon as you start deviating away from your core, that's when things go wrong. So, the reality is we're looking at careful growth within our core vehicle. We've had a number of investors, we'll be investor-led on what products we need. We're looking at raising capital via a note program up in Asia. We've had some investor-led discussions around looking at providing some of the credit risk modelling in offshore jurisdictions as well. But ultimately, we're looking at business lending in securitised warehouses and ultimately sticking to our knitting. We think that's how you keep getting it right for a longer time.
Yeah. So just to end, what do you think is the most important question a financial advisor should ask of a private credit fund?
I think you've got to know what's under the hood. You've got to know what risk you're taking. In the end, you should be compensated for or your investors should be compensated for the risk you are taking. So, I think we see a lot of funds touting, mid-teens returns. That's fine. That's an equity style return. You've probably got and you should have a higher probability of default across your portfolio there. So I think one key element is understanding what you've got exposure to, what the actual risk level is within that fund, what the manager's done through cycles. A new manager popping up. I mean, we've done our time. It's a hard few years to sort of prove yourself and gain the trust of investors and develop your track record. The other thing is looking at their reporting. We think it's important, and we always take feedback from our investors on what they want to see within the portfolio, but actually explaining your arrears levels within a portfolio. We've got 13,000 loans. We're always going to have some business. There's death, divorce, marriages, breakups, etc., that can happen within businesses, and there'll be circumstances you can't control that will impact a business's ability to repay. So these things are fine. They've got to be disclosed to investors and explained to investors. So I think you want to see transparency. You want to see an understanding of the risk being taken, and that communication and disclosure from your manager.
Okay, well, thank you, Brett. Thank you for your time today, and thank you for some very interesting discussion.
Appreciate it, Angela. Thank you.
No worries. For anyone listening to this, you can get more information about our rating at our website, and the link will be in the description. And if you don't have an account, registration is free, and you can find out more about Aura and Brett and his team by visiting their website, and we'll provide that link as well.